Return on invested capital is one of the most important yet overlooked metrics when analyzing a potential investment. And in this video, we're going to be looking at an example of 4 different businesses, and it's going to show us why return on invested capital is so important. We're going to look at an example of a poor business, an average business, a good business, and then a high quality business. Now, before we even start, we have to understand, why is return on invested capital important and what is it? Well, return on invested capital is simply a financial metric that measures how well a company uses its capital to generate returns and create value. Now, when we say create value, what does that mean? Well, basically, we have to understand free cash flow long-term drives market valuation. If a company is growing its free cash flow, then the value of the business long-term will grow as well. So what drives free cash flow? Well, return on invested capital and the growth rate drive a company's available future free cash flow. So as free cash flow increases, a company's valuation increases. Now, one of the people who was a huge fan of looking at return on invested capital was Charlie Munger, and he famously stated that if you invest in a business that can compound high returns on capital, you will likely outperform even if you overpay. So that's an interesting concept. Charlie Munger really believes in return on invested capital. And so does Warren Buffett. And if you look at the top holding of Berkshire Hathaway, it's Apple stock. Now that's interesting because Apple has a very high price to earnings valuation. It's sitting close to 34. But what a lot of people don't understand is Apple has an extremely high return on invested capital. You can see here I plugged in Apple and all the data is loaded in. And if we look at the past few years for Apple, return on invested capital has been unbelievable. We have 55.7%, 58%, and 49.9%. So despite the high valuation, Apple continues to outperform. So let's go ahead and jump into our example and see exactly what's going on here. So again, to start out, we have 4 different examples and 4 different businesses, ranging from a poor business to a high quality business. And in this example, we're going to assume they all have the exact same earnings over a certain period of time. Each of them made $100. Now, the question we have to ask ourselves is, how much capital did they have to invest in order to achieve these earnings? So we'll say for a poor business, it was around $1,667, average business $1,250, good business $500, and a high quality business only had to invest $250 to achieve $100 of earnings. So we can easily see what their return on invested capital is by taking their earnings and divided by the capital invested. So let's go ahead and drag this over. Okay, so now we can see the return on invested capital for the poor business was 6%, average 8%, good business 20%, and a high quality business, it was 40%. So again, this means to achieve these earnings, this is how much capital they had to invest. So again, high quality business, 40% return on invested capital, they invested $250 and achieved $100 in earnings from that capital invested. But we need to understand, how does this affect the valuation of the company? Well, let's assume they all have the same growth rate of just 5%. If we come down here and look at their reinvested earnings to fund growth, this is the amount they have to invest to achieve that 5% growth. So for the poor business, in order to achieve 5% growth, they would have to invest $83.35 to achieve that 5% growth. But for the high quality business, they would only have to invest $12.50 to achieve 5% growth. So for the high quality business, that leaves over $87.50 for earnings to owners after growth. Because remember, we have $100 total dollars in earnings. So in order to achieve 5% growth, they use $12.50 of that earnings, leaving $87.50 left over. So these are earnings that can be used to reward shareholders. They can do things like pay down debt, they can buy back shares, they could pay out a dividend, or even attempt mergers and acquisitions. So again, we're trying to see, how does this affect the valuation of the company? So what we need to look at now is the cost of capital, and we'll assume for all 4 of these companies it's 8%. Now, cost of capital is the minimum rate of return or profit a company must earn before generating value. So in order to calculate the value of the business, we take the earnings to owners and divide it by the cost of capital minus the growth rate. So let's look and see how this is calculated. If I delete this, we'll do equals, and in parentheses, we want to take the earnings to owners after growth and divide that. And in parentheses, we're going to take our cost of capital, which is 8%, and subtract out our growth rate and hit enter. And again, we can see the value of the business is $555. The value of the average business based off this is $1,250. The good business is $2,500, and the high quality business is $2,917. So now that we know the value of the business, we can get a valuation metric such as the forward price to earnings ratio. And to calculate this, we just need to take the value of the business. So we'll take this number here and divide it by what the earnings of the company was. We'll come up here and hit enter. And we can see based off of this, the forward price to earnings ratio would be 5.55. So on the surface level, this business looks very cheap, but it's cheap for a reason. It's because of the poor return on invested capital. They have to invest a lot of capital in order to achieve those earnings. But if we pull this over and look at the average business, we can see the forward price to earnings ratio is 12.5. Some would argue that's a little more reasonable. But if we look at the good business, the price to earnings ratio is 25. On the surface level, it's starting to appear a little more expensive, but that's because the quality of the business is so high. They don't have to invest much capital in order to achieve their earnings. But here's where things get really interesting. For the high quality business, we can see in this example, the price to earnings ratio is very high. It's sitting at 29.17, but it's because the levels of return on invested capital are so good. We get 4 different forward price to earnings ratios for companies that all have the exact same earnings. They have the exact same growth rate and the exact same cost of capital. So if you only paid attention to that price to earnings ratio, you would think that the poor business is the best investment. But this simply isn't true. You have to look at the return on invested capital because this makes such a difference over the long term. In fact, Charlie Munger believed this made such a big difference that he stated this: if the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 to 30 years, even if you pay an expensive looking price, you'll end up with a fine result. This is why Warren Buffett and Charlie Munger love buying high quality businesses, just like Apple stock. It's because they have such high levels of return on invested capital. So ratios like the price to earnings ratio really don't tell us the whole story, and we can't base our entire investment thesis off the price to earnings ratio. We have to also look at things like return on invested capital because some companies can justify the high price to earnings ratio. Because if a company can reinvest those earnings at a high rate, then the high price to earnings ratio is justified. This point is hammered home in a great PDF written by Kennedy Capital on the underappreciated variable in valuation, return on invested capital. I'll leave a link to this PDF in the description down below. But there's a few key points that I want to quickly point out. First off, traditional earnings valuation metrics like price to earnings and price to earnings growth ratio are not as reliable for valuing high growth firms as they do not capture potential return on invested capital changes. The level of sustainable returns at maturity is often underappreciated at growth stage firms. If we scroll down further, we can see high return on invested capital is more sustainable than high growth. When evaluating valuation, we must look at both the long-term expected return on invested capital and the average expected growth of a business over its life cycle. So let's hammer home this point just one more time and look at an example of the compounding effect. If we take a hypothetical example of company A and company B, in this example, company A has 10% return on invested capital and company B has 30% return on invested capital. And both of these companies choose to reinvest 40% of their earnings, and both begin in year 0 with $1,000 of capital to invest. So what happens? By the end of year 10, company A has accumulated $720 in cash and invested capital has grown to $1,480. Meanwhile, company B, who has the higher return on invested capital, has accumulated $3,159 in cash and invested capital has grown to $3,106. And if we scroll down, we can see the illustration of this example. So when you're analyzing stocks and you're trying to decide, is this stock cheap or is it expensive? We can't just look at the price to earnings ratio because it does not tell us the whole story. We have to also look at things like growth rates and especially return on invested capital. It's why Buffett and Charlie Munger have loved Apple stock for so long. And just like we saw in our example, 4 companies can all have the exact same earnings, but the value of the business can be radically different, which then leads to radically different forward price to earnings ratio. So I truly hope this video helped you better understand valuation metrics like price to earnings ratio, and more importantly, why return on invested capital is so important. And if you'd like to learn more about return on invested capital, again, I'm going to link this free PDF down in the description below. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.